Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello, and welcome back to today's podcast. Thank you very much for being here. I have a client I was listening to the podcast while his kiddos are driving, while he's driving with his kiddos, and they apparently love my hello. So hello, kiddos. All right. Today, we are going to talk about PaidUp policies, short-term pay policies, just types of policies that you can get. Because I had a reader reach out to me and say, hey, Mary Jo, can you explain in your book? I have in my Life Without the Bank book, or if you have my Wealth Without the Bank or Wall Street book, that book has the same illustration in it, talking about what to do with inheritance and large sums of money, getting it into a policy. And her question was, well, you only put premium in for 7 years and then you quit. And the policy still grows. So I'm assuming the policy is still active, but I've never seen a policy where we quit putting premium in. And so why is that? How does that work? Lots of good questions around it, which I don't explain in my books. And so I just wanted to go over today that there are many different types of policies and what those look like. I know that I have gone over this a little bit, touched on it in other podcasts, but I just really want to kind of break down what's happening in this particular scenario of my books. So if you do not have Life Without the Bank, or you don't have Wealth Without the Bank or Wall Street, and you've not read those books of mine, then let me just explain that the scenario in there is we have somebody that has inherited $500,000. So we take that $500,000, regardless if they got it through life insurance death benefit, if they got it through cash, whatever. If we take that $500,000 and we move it into a policy through paying premium, now I have the scenario in the book, we're only going to do this for 7 years. We're going to take that inheritance of $500,000, pay premium with it over 7 years, and then at the end of year 7, we have the $500,000 of cash value. But then the premium goes to zero. So this particular policy in the book would be called a 7-pay. You only pay premium for 7 years and then you're done. There are policies that are 10-pay. You pay premium for 10 years and you're done. 20-pay policies, pay premium for 20 years and you're done. PaidUp at 65, pay premium till you're 65 years old and then you're done. So there are policies that you do not have to pay premium the rest of your life. Ideally, when I'm setting up a policy, in most cases, I want to do a PaidUp at 121, meaning you're going to pay that premium till you're 121 years old. Not the full premium that we start with. It's going to reduce at some point due to the taxation, but ideally we want to continue to pay into that policy because of the fact that it compounds. If you have an inheritance, like I talk about in this chapter of the book, we may not have money to keep paying premium. So we may only be able to do a 10-pay, a 20-pay, a PaidUp at 65, something where we say, you know what, we inherited this, but we have no extra income coming in to continue to pay. So we're just going to do a policy that the premium does stop. The thing with these is you don't ever have the option to continue to pay. So I just recently, with all the changes that the life insurance companies made due to rate changes or interest rate changes, and then there's a new mortality table that came out a year ago, I have been doing more 10-pay policies on people that are 60 to 80, let's say. I rarely write anybody that's 80, but nonetheless. If we're going to do a policy on a 65-year-old, we may only do a 10-pay for a couple reasons. One, it's usually going to be a better buy for the cost of death benefit, which is what we're doing at 65. Cash value is actually going to perform fantastic. So cash value is a null point. It's going to perform the same in a policy we pay till we're 121 versus a policy that's a 10-pay. In the first 10 years, it's going to be amazing. Cost of death benefit in my scenario is going to be a little bit less. But premium is quite expensive on somebody that is 65. If we're going to build a banking policy for somebody that's between 60 and 65, we're in between $16,000 to $25,000 of premium a year. Now, keep in mind that's banking. The majority of that money is going to cash value. But because it's so high, a lot of times we may do just a 10-pay because it's going to buy, the cost of death benefit's going to be less. Cash value is going to be there. We only have maybe 10 years of income coming in to pay for it. I may use that strategy. Am I going to use a 20-pay or a 10-pay on somebody that is 20 years old, 30, 40 years old? No. I have not ever found a purpose for that. That doesn't mean that I wouldn't. Let's say that you are 50 and you inherit $1 million. We may do a policy that is something like a 10-pay or a 20-pay in that scenario because of exactly what I'm talking about in the book. We inherit a large sum of money or we come into a large sum of money. Now, we don't necessarily have the income to justify continuing to pay. Is it rare that I do that? Absolutely it is. Now, here's another thing. When you are looking at types of policies, if you get into a position where you had a lot of money coming in and now our income changed and we can't pay the premium, you can always do what's called a reduced paid up, meaning we're going to reduce the death benefit due to how much, whatever reflective of whatever cash value is in there, and no more premiums ever due. So you could stop paying your premium altogether. You can never start again, but you could stop paying your premium altogether at some point. Death benefit's going to be reduced. Cash value should remain the same. Those are just things we can do within the policy. And then in that case, with a reduced paid up, even the cash value will continue to grow. It's going to remain the same. It's going to be the same policy. It's still going to be active. So just because we're not continuing to pay premium does not mean that the policy collapsed on you. Doesn't mean that everything went away. It's just some of the policies like that, that is how they are structured for whole life. Now, I came across a policy just recently that was sold to somebody that was a universal life. And not only was it a second to die. Now, if you have heard me talk about, if you've heard my Facebook Lives, which I'm doing now at this time, if you're listening to this podcast, we're doing them Friday mornings at 7:30. So please join me. But they were sold a second to die policy, which I have not ever found the use for at this point. Do not like them currently, because they don't make sense to me for estate planning. So we have two people insured on the same policy, which I don't like. And I don't like universal life. So 2 strikes right there. But then on top of it all, it's like a pay to 85. And then if they don't die, they get their money back. What? what? Like, most people are going to live past 85 years old, but now we have a policy that we only pay to 85, and then it's a return of premium at 85. I didn't even know these things existed. Just when I thought things couldn't get worse, they got worse. So now we're paying in like $265,000 a premium to 85. If mom or dad, whoever the last one is to die, because that's how the policy's set up. So whoever dies last, if they die after 85, we have no death benefit. Zero zilcho. I mean, I haven't seen the illustration yet, but I'm assuming we're probably not going to even get to 85 in this policy. We will see it. Hopefully there's a guarantee on it. That would make some of this a little bit better. But in that scenario, we get the money back. Policy is done at 85. If we live to 86, we're done. No more policy. That is not how a whole life works if we're going to do a 10 pay, a 20 pay, a 7 pay, a reduced paid up. It's still going to go to age 121 because the costs were already paid. They were already figured in. So this was a really good question from the reader, because I sometimes assume that y'all know what I know. That is a terrible assumption. No one should ever assume. And I've used that twice now in this podcast. So no one should ever assume. And I typically do not like to do that. And I can't get absolutely everything in the book, hence the podcast. So fantastic question, because you guys are not life insurance agents. You don't need to know everything I know. But I would love for you to know everything I know. It would be awesome. So I'm happy to share it. I'm happy that the question came along because it's a really good question. Most of the time, if we see premium go to zero, what happened to the policy, right? Our first instinct is to say, okay, we don't have a policy because we quit paying premium. I was under the assumption I have to pay this the rest of my life because that's what Mary Jo has always said. Which is true in 90% of the cases. I do want you to pay the rest of your life because that's how we're going to make the most amount of money and create the most amount of wealth in that policy. Why would we stop paying when we have the compound interest and the dividends are phenomenal the longer we go? Why would we ever stop paying? That was a sales technique to be able to say, oh, you only have to pay for so many years. Other companies that I don't use, there are companies that do not have a paid up additions rider to be able to create the cash value as quickly as we do. Those companies will tend to do a 10 pay, a 20 pay, or a paid up at 65 so that you have cash value at 10 years. You have no cash value typically year 1 or 2, but you will have cash value year 10. That is their way to compensate. Now, I don't love it because why? When the policy really starts to get good and really start to produce the compound interest and the dividends at year 20, we stop paying premium. I don't care if we're only putting a few $1,000s in at 20. It's still a few $1,000s that are compounding long term. It's amazing when I see policies from when people were little kids. That might have been 40 years ago, but those policies are absolutely phenomenal. If you really look at what they've put in, what they have for cash value, the growth that it is today, no, the premium is peanuts in most cases because inflation has caused us to need more money today. But at the end of the day, in relation to what they've put in, it's a great policy. There's money that can be used. So when we see zeros on an illustration, that is typically I am going to be alarmed if it's a universal life and we see zeros in the cash value column, because then we're going to see zeros in the death benefit column. That means my policy collapsed. If I'm seeing zeros in the premium column, but I'm still seeing cash value and death benefit grow. My policy is still okay. Everything's great. We still get to use it. We still have a whole life policy. So don't be alarmed if you are seeing zeros and no premium due in the premium column. Because as long as there's cash value, as long as it's growing, we have a policy. If we are inheriting a large sum of money, or if we've sold something and we've got a large sum of money coming in, we may need to do a policy where we're not putting money in forever because we don't have the ability to do so. So that is why in Life Without the Bank, that is why that premium stops at 7 years. Wealth Without the Bank or Wall Street has that as well. So if you do not have Life Without the Bank or Wealth Without the Bank or Wall Street, I really encourage you to go grab this book, not because it is 100% different than Farming Without the Bank. I am going to be straight up honest with you. It is about 85% similar. So it's a good repetitiveness, but in Life Without the Bank, you are going to have, I go into far more detail on the market scam. And then I have this illustration of what it looks like and how to use inheritance and creating a little bit of generational wealth. So if you don't have that book and you just kind of want to see, some more market numbers as far as what are fees going to cost me, I also have a chapter in Life Without the Bank that talks about a better way to go to college, which is don't be spending cash on your kids' college. There are about 3 things in this book that are not in Farming Without the Bank. So if you do not have it, you will want to pick that up if those 3 things interest you. Again, the majority of the book is still going to have the same content as Farming Without the Bank. It is not a horrible idea to have the repetitiveness, because people will say, oh my gosh, you said it this way in Life Without the Bank versus Farming Without the Bank, and I got it then. So again, not horrible. However, great question, and I love them. I absolutely love when you guys send me questions or say, hey, Mary Jo, I need this on a podcast. I am going to oblige. I absolutely love to have the suggestions. So please, if you have some, keep them coming, because I listen and I want to make sure that we can get out as much information as we can so you can make an informed decision of what you want to do. Now, on that note, I am also going to say that I got an email from a guy this week, and he said to me, can I meet with you? Because I was so excited. I got your book in audio. I listened to it in audio. I did not read it. I have now read it and understand that I went to the wrong agent and what I got is not correct. They sold me something that is not infinite banking. Can you help me fix it? Well, of course, I can help take a look at it. We can set up a meeting. I'm happy to help. But again, these emails and this general comment, I hear a lot. Mary Jo, I went to my local agent. I didn't want to wait to get in to meet you. And now it's wrong. You guys, why throw your money away? If you're not going to do it right, wait. If you don't know if it's right, wait. Only once or twice, maybe twice, have I seen something that's correct, and then the agent still doesn't know anything about infinite banking to be able to help the client with the thought process around money. It absolutely drives me batty when I see people say, oh, this is another concept about using life insurance. Oh, this book is just about life insurance. Oh, for the love of Pete, did we miss the whole first part of the book? This book is not about life insurance. If we miss the concept about infinite banking, we might want to go back and reread that. This is about a concept. Anybody can sell you a life insurance policy. No, it may not be correct. Yes, it is the tool, but we don't know how to use the tool without the instruction, right? Why wouldn't you want somebody to help you use it correctly? I would prefer we start correct rather than me having to fix it. I don't mind fixing it. And in this case, it's going to probably be an easy fix. He just started. What's not going to be easy for you is having to go back and say, hey, I want to either cancel that policy, or you did this wrong, or I lost money. This is not about losing money. So please, I understand that my calendar is full. I also know that every week, now that we're getting into planting season, I also know that people are canceling and rescheduling due to weather. It happens all the time. Please get on the waiting list. You could be in within 24 hours. As long as you're ready and you have your numbers ready and we call, check your phone, right? Check your messages. If we're calling, you could get in the next day because people will cancel when we call to remind them of their appointment. So don't think that you're going to have to wait forever. And is it okay to wait a couple of weeks just to make sure everything's right? I say, yes, it is. But that's me. So take that for whatever you'll like. But I hope that helped explain what are we going to do with the large sum of money. We don't have to continue to pay. The policy doesn't go away. So thankful for the question. Hope that you guys found that beneficial. Please let me know if there is absolutely anything else that I can answer, that I can do. I am here to help. You know my email address, maryjo@withoutthebank.com. Tune in to my Facebook Lives, 7:30 Friday morning. They're always replayed as well. They're on YouTube if you care to share them. Great Facebook Lives that go over just strategies and clients that I've met with for the week. And it's just always good information for those of you that are saying, is this for me? Who is she helping? Can she help me? I am sure that I have helped somebody that is doing something almost exactly like you. And there's always a way. Where there's a will, there's a way. All right, you guys have an absolutely fantastic rest of your day. If you need the book, you can go to farmingwithoutthebank.com and grab that. Otherwise, we will talk to you in the next podcast. Have a good one.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.